Okay, and then the factory worker says to the CFO, why even bother with a production budget? Are all the letters in science majors gone yet?
Don't stop, make it pop, DJ blow my speakers up tonight. I'ma fight till we see the sunlight.
Alright folks, so today is your lucky day. You don't have to stare at my face for the majority of this video, because the majority of this video is going to take place down here. And when I say down here, I mean in your textbook. So, open up your textbook to page 397. We'll be going over E9-2. So as you're doing that, we're going to transition to Excel. Alright, hello class. We're going to be going through E9-2 today, so please open your books to page 397. That is where you find E9-2. E9-2 is talking about Down Under products of Australia. And they have budgeted sales of its popular boomerang for the next 4 months as follows. You'll see they give you a nice little chart there. That chart's going to come in handy later. They also tell us that end of month inventory levels must equal 10% of the following month's sales. And the inventory at the end of March is 5,000 units. All this data is going to be key as we're going through the problem. So to start off the problem, why don't we start with the top of our file in Excel. We're going to write down the name of the company, Down Under Products, followed by the name of the budget that we're doing, specifically the production budget. Once we get that out of the way, we're going to list the different columns that we're going to be using, and in this case it's different months, April, May, and June. Sometimes it'll give you quarters 1, 2, 3, it could even give you year 1, 2, and 3, or something like that. In this case, we're going to be using months, April, May, June. Notice you do not use July as its own separate month. That's not part of the quarter. We're going to be using that data in July that they give us, but it's not going to be a specific column in our table. Alright, now that we got that out of the way, we're going to move down to the first row of our calculations. That's going to be budgeted sales. Budgeted sales they give us right in that chart. April's got 50,000, May's got 75,000, June's got 90,000. You add those up, you get 215,000 for the quarter. That's pretty simple. So now that we have budgeted sales for each month, we have to add to that the desired ending inventory. What's the desired ending inventory going to be for each month? It's going to be 10% of the following month's sales. So look at April. How are we going to get the desired ending inventory for April? Well, we're going to look at May's budgeted sales of 75,000 and multiply that by 10% to get 7,500 for April's desired ending inventory. You're going to do the same thing for May. In May, you're going to look at June's budgeted sales of 90,000, multiply it by 10%, you get 9,000 desired ending inventory for May. How are you going to get June's? Well, this is why they gave us July's budgeted sales. They told us that July's budgeted sales, 80,000. 80,000 times 10%, 8,000 desired ending inventory for June. Notice, don't add these numbers up just to get your total for the quarter. We're trying to get the desired ending inventory here. So, the desired ending inventory for the quarter is going to be the desired ending inventory for the last month in the quarter. In this case, June, 8,000 is going to be the desired ending inventory for the quarter. Move on down, next line, total production need is just going to be summing those top two lines up. Budgeted sales plus desired ending inventory gives us total production needed. Next line, once we have the total production needed, we have to subtract out what we already have in beginning inventory for each month. So, how are we going to find out April's beginning inventory? Well, they tell us that the inventory at the end of March was 5,000 units. If the inventory at the end of March is 5,000 units, the inventory at the beginning of April is also going to be 5,000 units. Alright, so we got April. How are we going to get May? May's beginning inventory is going to be April's ending inventory. So notice, in April we had ending inventory of 7,500. That's going to be May's beginning inventory. Same thing for June. That's where we get the 9,000 from. Look at it, see where we get that 9,000 in May's column. Then, for the quarter, beginning inventory is going to be the beginning inventory in the first month of the quarter. Therefore, it's going to be 5,000, and we got that number from April. Now, final line, required production. Take your total production needed and subtract out your beginning inventory, and that's going to give you the required production for each month. Sum up those required production amounts, and that's going to give you your total required production for the quarter. And that's how you solve this problem. The key thing I want you to get, other than finishing this production budget, is notice the relationships between the numbers. Notice how we got that ending inventory. We took the following month's sales and multiplied it by the 10% to give us that buffer or cushion of inventory. And then for the beginning inventory, we took the previous month's ending inventory. Notice the relationship between the numbers. You're going to see these kind of same relationships throughout all of the budgets. So it's important to understand the flow of numbers. And that's how you do E9-2.